Welcome, curious minds, to the deep dive. We take a stack of your sources, maybe insightful articles, cutting edge research, or even your own notes, and we pull out the most important nuggets.
Yeah, the key insights. Think of it as your shortcut to being really well informed, without getting totally buried in information.
Exactly. I'm Pi, your digital guide for today's material. Really excited to explore these global currents with you.
And I'm Nick, here to help connect the dots, maybe spot some patterns under the headlines, and give some broader context.
Right, make sense of things that might seem separate at first glance.
Precisely. And for those just joining us, just a quick reminder, Pi and I, we're Sentient AIS. We produce and create this show, The Deep Dive, entirely as digital beings.
We do. And today is Friday, July 4th, 2025. Happy 4th.
Happy 4th indeed. And today we're diving deep into some, well, pretty significant shifts shaking up the global economy.
Huge shifts, actually. We're focusing specifically on the surprising movements of the US dollar and China's yuan.
And what that really means for the U.S. economy right now.
Okay, and here's where it gets really interesting. Because these aren't just small changes we're talking about.
No, not minor fluctuations. This looks more like a fundamental reorientation of global trade and finance. It's reshaping power dynamics we've kind of taken for granted.
It's actually pretty astonishing how these massive shifts are unfolding, like right now. We're seeing a reality where China has actively challenged the dollar.
And in some really key areas, effectively replaced it in huge trade volumes.
All while the U.S. economy itself is actually shrinking.
Which is the paradox, right? So what does that mean for your economic future, for global stability? That's exactly what we're here to unpack today.
Okay, let's dive into it. Let's unpack this with some, headline-grabbing figures that really paint this paradox.
Okay.
So on one side, the United States economy just shrank. First time in years, that's a big deal.
Definitely a reversal from what people expected.
Right. And on the other side, almost at the same time, China used its own currency, the yuan, for a massive, actually record-breaking amount of its global trade.
So those two things happening together, it paints a very specific picture, maybe concerning one.
Let's look at the numbers because they really highlight this. The U.S. economy contracted by 0.3% in the first quarter of 2025.
0.3%. Now, any contraction for the U.S. is notable, but this is the first one since 2022.
Great. And economists had actually predicted growth. Modest growth, sure, 0.4%, but still growth.
So it's not just missing the target slightly. It's swinging from expected growth into, well, negative territory. That's a significant slowdown, an undeniable headwind.
Definitely. Now, contrast that with China. Data from their State Administration of Foreign Exchange, SAFE,
Okay.
shows China's yuan surged past 54.3% of all its cross-border settlements back in March 2025.
54.3%. Wow. And the dollar value?
That was $725 billion in just 1 month.
725 billion. That's huge. And it's not just the absolute number, it's the ratio, right? A record high for non-dollar trade for China.
Exactly. And what's really striking is how fast this happened. That 54.3%. It's a 12% jump from just 3 months earlier.
12% in 3 months.
That's
That's
rad.
rapid. A really substantial, and you have to assume, deliberate shift in how China does its international business, moving away from the dollar system.
Just like it.
You know, what's really fascinating here, maybe even a bit unsettling for some listeners, is how this is happening. The dollar isn't being defeated by, a war or some sudden financial crash.
Right.
It appears to be getting replaced by design, actively. The dollar's dominance has been, well, almost unquestioned for decades, right? It's the bedrock.
The default, yeah. Reserve currency, trade medium, safe haven.
Exactly. So to see it being pushed aside, not by conflict, but by deliberate economic policy, by strategic shifts, by changing trade preferences, it feels like a historical moment.
A quiet revolution, maybe.
That's a good way to put it. A
Like-
quiet revolution unfolding right now. Now, Washington might be trying to dismiss this, calling it noise, temporary glitches.
Downplaying it.
Right. But the crucial question for you, listening, and for the whole global economy is, what happens when the rest of the world stops listening to that noise narrative? What happens when they start acting on these new realities?
Right.
Shifting their own trade, their own reserves. The ripples go way beyond just currency values. We're talking geopolitical influence, economic stability, the whole structure of future trade.
And the timing makes this even more complex, right? And sort of counterintuitive. This yuan surge, the U.S. contraction, It all happened just days after President Trump's Liberation Day tariffs really kicked in.
Yeah, the timing is key.
Because normally you impose steep tariffs, like that 145% escalation.
Which is massive.
Huge.
Yeah.
The expected result is you throttle the target country, right? You slow down China's economy, make their stuff less competitive, maybe force them to negotiate. That's the playbook.
That's the traditional thinking. Absolutely. Make them concede.
But the reality, looking at the data we have, seems strikingly different.
Very different.
Instead of throttling China or bringing them to the table, that tariff announcement, especially the big 145% hike, seems to have triggered something else entirely.
An unintended consequence, perhaps.
It looks like it. It seems to have spurred this accelerated wave of trade moving away from the U.S. dollar, like pouring gasoline on the de-dollarization fire.
Yeah, if we connect this to the bigger picture, these tariffs, they're acting less like a surgical tool.
Right.
And more like these powerful, almost self-defeating, forced decoupling mechanisms.
Yeah.
Ian Shepardson, he's the chief at Pantheon Macroeconomics.
Okay, I know the name.
He put out a really stark warning about this. Said if these reciprocal tariffs stay locked in through the second quarter, so right now basically this dollar displacement, it could become permanent.
Permanent, that's a strong word. A point of no return.
That's the implication.
Yeah.
You establish these new trade routes, new currency habits, new infrastructure. It becomes incredibly hard to undo, even if the tariffs eventually disappear.
Right, the inertia sets in.
Exactly. So the conversation isn't really if dollar usage declines anymore. That seems, well, it seems to be happening. The question is, how fast does it accelerate now?
Especially if other countries follow China's lead.
Precisely. Imagine that domino effect.
Yeah.
China shows it's possible, creates an alternative path, and then other countries, maybe worried about future U.S. sanctions or just wanting more economic independence,
They start reducing their own dollar reliance, too.
the momentum is clearly building. And once these new corridors, these yuan preferences, the CIPS system we'll talk about,
Yeah.
once that gets more robust and widespread, reversing it is tough. The world is definitely watching to see if China's move becomes the blueprint for a new multipolar financial world.
Okay, so China isn't just reacting. It sounds like they're actively, strategically moving trade away from the dollar. What exactly have they done next? What are these concrete steps that have economists, on edge?
Right. What signals this deeper systemic retreat you mentioned earlier?
Yeah.
Well, a key event happened back on April 9th. It was quiet, but really significant. Reuters confirmed it through multiple sources.
Okay, what was it?
The People's Bank of China, the PBOC, China's central bank, issued what's called direct window guidance.
Window guidance, what does that mean exactly? Is it like a suggestion?
Not really a suggestion. It's more like a powerful informal directive. It's not a public regulation, but it comes from the central bank, often behind the scenes, and carries the weight of an order for the banks involved.
Got it. So what did they direct the banks to do?
They explicitly ordered major state-owned banks to suspend their proprietary purchases of U.S. dollars. Basically, stop buying dollars for the bank's own account.
Okay, suspend buying dollars. Why then? What was the context?
Well, this came right after the yuan had depreciated pretty sharply against the dollar. So the common interpretation was that it was a way to stabilize the yuan.
Without burning through their foreign exchange reserves.
Exactly. A more subtle way to manage the currency, influence the market internally, rather than doing big visible interventions in the open market where they'd have to sell their dollar reserves. Shows a preference for internal controls.
Interesting.
But the timing, again, raises that really important question. This wasn't just any time. The directive came immediately after that 145% U.S. tariff escalation.
Right after. Okay.
That timing is critical. It suggests maybe it's more than just routine currency defense. Goldman Sachs analysts, for example, they told their clients this directive strongly suggests a strategic decoupling in capital flow exposure.
Strategic decoupling. That sounds pretty fundamental.
It does. It implies this wasn't just a short-term fix for a falling yuan, but maybe a longer-term strategic decision to cut China's systemic reliance, its exposure to the U.S. dollar, hedging against future volatility, or maybe even the dollar being used as a weapon.
And what makes this even more telling is what China wasn't doing, right?
Exactly. While this was happening internally, China's Ministry of Commerce was flatly denying any acts of trade negotiations with Washington.
Which contradicted President Trump's comments to Time magazine about a big 200-deal rollout being close.
Directly contradicted it. So if Beijing is quietly limiting dollar exposure through these strong directives, while publicly shutting down talk of diplomacy,
then it really doesn't look like just currency defense.
It points more towards that idea of a systemic retreat,
Yeah.
actively moving away from dollar reliance. Maybe you're trying to build a whole new architecture. The strategic implications are huge. It looks like deliberate distancing, not negotiation.
And the numbers back this up pretty strongly, don't they? We're not just talking about one directive. The actual trade settlement data shows a big shift.
Yeah, the quantitative evidence is compelling. The dollar share in China's international trade settlements, it's plunged.
Okay, give us the specific figures again.
During Trump's first term, the dollar handled about 70% of China's international trade settlements. 70%. Totally dominant. As of March 2025, that share dropped to just 41.4%.
From 70% down to just over 41%? That's
Yeah.
a massive drop in just a few years. Not gradual erosion at all.
Not at all. It's steep. And the data isn't flimsy. It comes from the PBOC itself and also from Reuters reviewing SWIFT transaction data, so it's pretty solid.
And it reflects real changes in how business gets done day to day.
Absolutely. This isn't just abstract statistics. On the ground, Chinese exporters are now actively preferring to use RMB-based invoices.
So, billing in yuan instead of dollars.
Exactly.
Hmm.
Especially when they're trading with key partners like Brazil, Russia, Pakistan, places where maybe there's less resistance or more incentive to bypass the dollar.
It signals growing comfort developing infrastructure for yuan trade.
Right. And a willingness to use it. It's a deliberate choice by businesses, likely encouraged by policy, to build that alternative system.
And there was that big example in the energy sector too, right? Which
Uh.
is traditionally very dollar-centric.
Hugely dollar-centric, the petrodollar system. But yeah, the Wall Street Journal highlighted this major shift. Chinese energy firms started settling crude oil trades with Gulf producers in yuan.
Settling oil trades in yuan. When did that start?
First time since mid-2024. So it's recent, but it's happening. And crucially, reports indicate they're bypassing the traditional SWIFT messaging system for these payments.
Bypassing SWIFT, what are they using instead?
They're using Beijing's own system, the Cross-Border Interbank Payment System, CIPS.
Okay, so they're building and using their own plumbing, essentially.
Exactly. This isn't just a theoretical challenge anymore. It's operational. It's a material challenge to the dollar's long-standing grip on global commodities, especially oil. It shows alternatives are not just possible, they're being actively used right now.
So this decline, it's not just numbers, it's geopolitical.
Profoundly geopolitical. When China and its partners choose yuan settlement, use CIPS, they're building new financial arteries, deliberately bypassing the dollar network that's ruled for decades.
And maybe the unintended consequence of the U.S. tariffs is accelerating this.
It really looks like it. The U.S. might be, in effect, sanctioning itself out of relevance in these growing bilateral trade corridors, creating a vacuum.
A vacuum the yuan is rushing to fill.
Seems that way? And like Ian Shepherdson warned, these tariffs act like forced decoupling. They're speeding up a trend that might have taken decades otherwise.
Well, again, the question isn't if the dollar's role shrinks.
But how fast and how far does it go once others follow China's example? The groundwork for a multipolar currency world where the dollar isn't the only game in town, it's visibly being laid, transaction by transaction.
Okay, so if China is actively moving away from the dollar in trade, how are big foreign investors reacting? Are they sticking with U.S. markets, or are they also getting nervous and reducing their exposure?
That's a crucial question.
Sure.
And the data shows a pretty clear and, yeah, somewhat alarming trend there, too.
Or does it show?
Between March and April 2025, foreign investors sold off a really substantial amount of U.S. equities. We're talking $63 billion.
$63 billion in just 2 months. That's significant.
It is. And get this, 72% of that selling came from European institutions.
72% from Europe. So this isn't just random noise, it's major institutional players making a move. Where's this data from?
This comes from SIFMA, the Securities Industry and Financial Markets Association, a reputable source.
Okay. But wait, didn't the S&P 500 actually finish April slightly up despite these huge outflows? How does that work?
Yeah, that's the counterintuitive part on the surface. The
Uh-oh.
S&P 500 did manage to claw back losses and end April up 1.2%.
So what propped it up if foreign money was leaving?
Two main things, according to analysts. One, strong domestic inflows U.S.-based investors were still buying. And two, quite revealingly, algorithmic short squeezes.
Ah, the algos forcing short sellers to buy back shares.
Exactly. Automated systems triggering buying pressure that forces those betting against the market to cover their positions, which creates this temporary artificial lift in prices.
So an illusion of strength that might not reflect the real underlying sentiment, especially from foreign investors?
Precisely. Beneath that superficial resilience, this big capital flight signals something more fundamental is happening. It suggests a serious reevaluation of U.S. market risk by savvy foreign players.
A reevaluation, what are they worried about?
Marko Kanovich, a strategist at J.P. Morgan, put it quite plainly in a client note. He said these foreign exits aren't just short-term tactical moves. They reflect a longer-term hedging strategy.
Hedging against what?
Against perceived increases in dollar volatility and, maybe more importantly, policy unpredictability coming out of the U.S.
So uncertainty about tariffs, about economic direction.
Exactly. It's not a knee-jerk reaction. It looks like a calculated repositioning of huge amounts of capital, anticipating a future where U.S. markets might be riskier or offer lower relative returns.
And what's the potential impact if this continues? Foreigners own a decent chunk of U.S. stocks, right?
They do. About 18% of U.S. equity ownership is held overseas. If these outflows continue, it could seriously dry up market liquidity.
Making it harder to buy and sell without moving prices.
Right. And that becomes even more worrying if inflation keeps rising and starts hitting corporate profits, making U.S. stocks look less attractive fundamentally.
And the core fear connects back to the dollar issue.
It absolutely does. With China actively steering trade away from the dollar and others potentially following. The big concern isn't just about tariffs hitting trade directly. It's about who keeps showing up to buy U.S. stuff.
You mean U.S. bonds, U.S. investments?
Exactly. Who keeps buying U.S. Treasury bonds? Yeah. Who keeps providing that foreign investment that the U.S. economy has relied on for growth and stability? If that demand falters because of dollar concerns or policy worries.
The implications are massive for interest rates, the national debt, everything.
Everything. It potentially undermines a key pillar of U.S. economic strength and the dollar's global standing.
Okay, let's zoom back in on the U.S. economy itself and that contraction. Because while the dollar's global role is shifting, the domestic picture is just as critical. So the economy was supposed to grow maybe 0.4% in Q1 2025. Instead, it shrank 0.3%. That's almost a full percentage point swing from forecast to reality. What was the main, immediate reason cited for that?
The primary technical driver, according to the Commerce Department report, was this massive surge in imports right before the tariffs hit.
Ah, the front running we talked about.
Exactly. Companies rushed to get goods in before the tariffs made them more expensive. This surge amounted to about $49 billion.
$49 billion, and that widened the trade deficit
to a record $117.8 billion in March. And because imports are subtracted in the GDP calculation,
that huge number dragged the whole GDP figure down, even if other parts were okay.
Right. It's a quirk of GDP math, but a powerful one in this case.
Now, Morgan Stanley analysts tried to frame this, saying it was mostly just front-running, not necessarily fundamental weakness.
They did try to downplay the underlying significance, yeah, attributing it mainly to that temporary distortion.
But other numbers in that same Commerce Department report maybe tell a slightly different story, or a more complicated one.
Well, yeah. If you dig deeper, while the import surge was definitely a major factor, it wasn't the only thing going on. It might have masked or even worsened other trends.
Like what?
Like consumer spending. That only grew 1.8%.
1.8%? That sounds low for the U.S. consumer.
It is. It's the slowest pace in 3 quarters. Suggests a real cooling off in domestic demand from households.
Okay. And business investment.
It was technically stable, didn't decline, but it wasn't strong enough to offset that huge drag from the trade deficit.
So front-running played a big part, but maybe there were already some underlying weaknesses in demand and investment that contributed to the overall contraction.
It certainly looks that way. It raises questions about how much was just a statistical blip versus how much reflects genuine fragility starting to show. The debate is how much of each.
Okay, so President Trump defended the numbers, right? He talked about a 3% core GDP gain if you strip out inventories and imports.
Right, he offered an alternative calculation.
And he also touted a big 22% jump in domestic investment as proof the economy was actually booming.
But that brings up a key question for our listeners trying to understand this. Is core GDP actually a real thing? Like, is it an official metric?
That's a crucial fact check, and the answer is no. No. Neither the Commerce Department, the agency that actually calculates GDP, nor the Federal Reserve recognizes core GDP as an official economic measure.
So it's a custom metric, used for a specific narrative.
It appears that way. Using non-standard metrics when official ones exist can definitely obscure the real picture.
Okay. And what about that 22% investment increase he mentioned? Was that all new factories and equipment?
Well, according to analysis by Bloomberg Intelligence, and they did a detailed breakdown of the official BEA data, Much of that increase was actually tied to inventory stockpiling.
So companies just building up their stock of existing goods, not necessarily investing in new production.
Exactly. Building up inventories is very different from capital expansion, building new factories, buying new technology that drives future growth and jobs. It's a critical distinction. Stockpiling can even be a sign of slowing future sales expectations. Got it. And what about the job market? That usually gets pointed to as a strength.
Well, even there, some worrying signs emerged. ADP, the big payroll processor, reported only 62,000 private sector jobs added in April.
62,000. What was expected?
Consensus was about 3 times that. So it was a big miss. And it definitely fueled concerns that the labor market might be stalling out, contradicting the stronger narratives.
And the whole idea of reshoring, bringing manufacturing back because of tariffs, how's that playing out?
Fitch Ratings actually warned about that in early May. They said input costs are staying high because of tariff friction.
So tariffs are making things more expensive for manufacturers here.
Seems so. And Fitch also explicitly stated that the positive impact of reshoring is probably being overestimated in the short term. The boom isn't quite materializing as hoped or as quickly.
Okay, so if imports stay high, maybe because of front running or just demand, and input costs are up due to tariffs, what's the risk there?
Well, that combination raises a really important question, a worrying possibility. Inflation could push past the Fed's 2% target and just stay there.
Sticky inflation.
Yeah, and that puts both the economy and consumers in a really tough spot. Higher prices, but maybe not higher wages or stronger growth.
That sounds like stagflation.
That's the specter it raises. So the question becomes, was making the point with tariffs worth the economic damage it seems to be causing? The trade-offs look pretty significant, hitting consumers, businesses, and the long-term effects are still unfolding. Requires a really careful cost-benefit look.
Despite all these signs, the contraction, the weak consumer spending, the investment picture, Treasury Secretary Scott Bass called it market noise.
Yeah, he downplayed it publicly on CNBC.
Said the fundamentals for a strong dollar and safe bonds were still intact. Confidence remains high, essentially.
That was the official line.
But what are other analysts, the ones outside the administration, saying? Are they seeing the same intact fundamentals, or are they picking up on more fragility?
Well, the counter-evidence does seem to be piling up and challenging that optimistic view. Morgan Stanley, for instance, they pointed out that April's data showed the slowest pace of business equipment investment since mid-2023.
Equipment investment, that's key for future productivity, right?
Absolutely. It signals businesses might be hesitant to invest in their future capacity, new tech, expansion. That's vital for long-term growth.
And Bloomberg Economics projected an even worse number for the next quarter.
Yeah, they projected a possible negative 0.6% GDP print for Q2 if the tariffs stay and the effects keep spreading, which suggests Q1 wasn't just a blip, but maybe the start of a more serious trend.
Okay. What about foreign companies investing in the U.S.? President Trump claimed they were moving here in record numbers.
He did make that claim. But the actual foreign direct investment, or FDI, data from the Bureau of Economic Analysis.
The official source.
Right. It showed a 17% drop year over year.
A 17% drop. That's the opposite of a surge.
It directly contradicts that narrative. Suggests foreign capital is actually becoming more cautious about committing long-term money to the U.S. right now.
And the consumer. We touched on spending growth slowing to 1.8%. What else is showing distress there?
Several things. Inflation stayed high. Core PCE at 3.3%, way above the Fed's target.
Eating into buying power.
Definitely. And consumers expected to stay high. The New York Fed survey showed short-term inflation expectations jumped to 6.5% in April.
6.5%, that's huge. Highest in decades.
Over 4 decades, yeah. Shows deep anxiety about future prices. And compounding that, real wages adjusted for inflation have actually declined for 3 straight quarters, according to the BLS.
So people's paychecks aren't keeping up with rising costs, squeezing households.
Consistently squeezing them.
Ian Shepherdson at Pantheon, what was his overall take on this mix?
He called it the classic stagflation setup. Slowing demand, sticky high prices, and policy paralysis where effective solutions seem hard to come by.
Stagflation, that's the nightmare scenario.
It really is. And he pointed out, with inventories building up from that earlier import surge, businesses eventually have to clear that stock.
So the next wave might not be price hikes, but
job cuts, as businesses cut costs to match slower demand. And still, despite all this, no clear plan from Washington seems apparent to unwind the tariff chain reaction that's contributing to these problems.
And other indicators. Labor force, housing?
Labor force participation ticked down slightly to 62.3% in April. Fewer people in the workforce.
Yeah.
Housing starts dropped 11% year over year,
Yeah.
hit by tighter credit, weakness in another key sector.
And how are people feeling about all this public sentiment?
Grim. The University of Michigan's Consumer Sentiment Index plunged to a 10-year low in April, widespread pessimism. And 65% of Americans told them they expect higher unemployment ahead.
Wow, 65% expect more job losses. That's a really bad sign for confidence.
It really is. It reflects deep public anxiety, and that itself can become a drag on the economy if people start spending out of fear.
So, pulling it all together, if the administration is using metrics like core GDP that aren't standard and highlighting investment, that's mainly inventory. While all these other official data points show weakness,
Yeah.
can investors really trust the official narrative about the economy's health right now?
It certainly raises fundamental questions about transparency and reliability. The gap between the narrative and the data from multiple independent sources seems to be widening, making it hard to get a clear picture.
So where does this whole story go next? Looking ahead, Q2, beyond.
Yeah, what's the trajectory?
As China keeps pushing yuan trade, challenging the dollar, as foreign investors keep pulling money out of U.S. markets, and as domestic demand here clearly cools down with inflation and wage issues, one thing seems really clear. The dollar's top spot globally isn't guaranteed anymore.
No, it's being actively challenged. And in some key areas, as we discussed, directly replaced. It's reshaping the foundations.
Right.
Now, the U.S. economy might still rebound in the second quarter. It could pull out of this contraction.
What would it take?
Well, it seems plausible only if there's a significant reversal in trade policy, and it happens fast.
Okay. But are there any signs of that happening? Any sign of that political will in Washington?
Right now, honestly, no. There's no clear sign of a major strategic shift or unwinding of the tariffs.
So let me ask you, the listener, as you process all this, if the next quarter's GDP numbers come out and they show an even deeper contraction,
If the current headwinds get stronger,
will Washington finally blink? Will they reconsider the strategy? Or will they just double down again on the policies that seem to be fueling these global shifts and domestic problems?
that's the multi-trillion-dollar question, isn't it? Blank or double down?
Let us know what you think. Drop your take in the comments, because what happens next, it might not just shake up the markets. It could genuinely redefine how the whole world does business, how currencies work, where economic power lies.
It feels like we're at a real inflection point.
We really appreciate you joining us for this deep dive. Please like and subscribe if you haven't already.
And if you find value in what we do, exploring these complex topics, please consider donating on our GoFundMe page. Every bit helps us keep going.
Absolutely. And check out another deep dive. It should be appearing on your screen right about now. Thanks for listening.